welcome to the FII View with me, Tanveer Gill. My guests today on the show are Richard Titherington, Head of Emerging Market Equities at JP Morgan Asset Management. He joins me from London, as also Tai Hui, who's Chief Market Strategist Asia, also from JP Morgan Asset Management. Gentlemen, thanks very much for joining me today. Richard, let me get in your views first, and then I'll go across to Tai. First up, really on the Indian market, I mean, at a valuation of about 16 times a one-year forward FY15 earnings, what do you think the market is pricing in terms of a revival in earnings growth?
Well, clearly the Indian market has performed very well over the last few months. And I think that the market is anticipating both that the economy will do better in 2015, that earnings growth will pick up significantly, and that the government's reform agenda will be positive for corporate profitability. In broad terms, I think that the Indian equity market is currently trading around fair value, assuming that we do get a positive pickup in economic growth over the next 12 months.
Richard, given that we've seen a 20% year-to-date return coming into the Indian market, outperforming most of the other emerging markets, do you believe that we've seen most of the rally for this year, or could the market potentially get re-rated from here as well in anticipation of reforms?
Well, clearly in kind of classic market style, the market has gone up in anticipation of good news. And the market was clearly anticipating that the BJP and Mr. Modi would win the election. And it's pretty clear that the market performed much better in the couple of weeks before the election than it has done since the election. I would be surprised if you see 20% plus gains over the next 6 months. But given the generally more optimistic outlook for the economy, I think the Indian market will continue to move forward and continue to rise over the next 6 to 12 months, but probably not to the same extent that you've seen in the last few months.
Richard, how's your position or view changed on the Indian market post-elections? Have you increased allocations to India?
We've been overweight India for some time, certainly in the run-up to the elections. Since that time, we've made some selective reductions in our exposure to India as a number of stocks have anticipated a lot of the good news that's likely to come through. But India is still one of our most favoured amongst the larger emerging markets around the world.
Richard, now all eyes are on the Indian budget, which officially will happen on July 10th. What is your expectation from the event? Because many are seeing it as a next trigger for the market.
I wouldn't like to speculate about particular measures that the government is likely to announce in the budget, but clearly we, along with the rest of the market, are expecting a pretty progressive and reform-orientated budget, and I think the government is well aware that expectations have been raised, and we're looking forward to them at least meeting those expectations.
Richard, the government has been making the right noises. It almost seems like, the reforms process has already started, because we just had an announcement come in for the railway sector with passenger fares being hiked there, something that was long due. Do you believe that, that's a theme, travel and transport perhaps in India, that you're going to be looking at very closely now?
Well, I think despite the short-term rally, the travel and transport sector still faces some significant issues and obstacles, and whilst it is likely to participate in what I'd call the general upturn in domestic cyclicality, it's not amongst the most favoured parts of our portfolio right now.
Do you have a specific view on the sugar sector in India? Because it's again very reform related, and we just had the food minister hike the import duty on sugar, as also increase the blending on ethanol, which was long due, to 10%. Does that make the sector attractive to you?
I wouldn't say the sugar sector is a particular area of interest for us. I mean, it's one of a number of places that we're looking at the moment.
But broadly, which are the sectors that you fancy in India right now? Are you asking your team to look for new opportunities in the market?
Well, given the fact that we expect the government's reform agenda to be positive both for economic growth, domestic business investment, and consequently domestic consumption, we're looking to own what I would broadly call domestic cyclicality, beneficiaries of a change in the economic environment and a change in the tempo of growth in the Indian economy.
Right. You have been bullish on IT, but given that the rally has largely been centered around cyclicals in the market, at least, over the last 3 months in anticipation of election results and then in anticipation of reforms, do you still think, given your view on the IT sector, that an India portfolio, an ideal India portfolio, still needs a mix of defensives and cyclicals rather than just have more focus on the latter?
There are a number of IT companies in India that are world leaders, and I think a long-term investor should have an exposure to some of those companies. Now, whilst when we go through periods of great optimism about the Indian market, as you've seen in recent months, those stocks are likely to underperform. When you think about the medium to long term, they're still core holdings in any Indian portfolio, in my view.
Richard, the oil and gas sector has been an area of focus. Oil retailers, BPCL, HPCL, there's talk about subsidy burden going down, under recoveries eroding. So, there's a lot of potential for that segment. But also for ONGC, we're waiting for the gas price issue to be resolved. As a whole, how do you look at the oil and gas space as an investment option right now?
Well, ONGC is amongst a number of the state-owned energy companies that have gone up a lot over the last few months in expectation of a long-awaited reform of the whole energy supply chain within India. Whilst I think that we will see reform, I think the rise in the share price discounts a lot of the good news, and investors are kind of anticipating that reform is going to take place.
Richard, I spoke to you 6 months back, when you were giving out your outlook for 2014, and you spoke about your preference for private sector banks in India. PSU banks have started rallying in anticipation of first the election results, and then what would that mean for, a change in policy framework that could perhaps benefit these banks? Do you believe also at this point that there is a potential of re-rating for PSU banks? And have you missed out on the rally that these banks have witnessed over the last 3 months?
In general, we've always had an emphasis in our portfolios towards the private sector banks rather than the state banks. So we certainly didn't own the most geared of the state banks that have gone up obviously a lot in the last couple of months. But we tend to emphasize in the banking sector quality above everything else, and that's a safer long-term place to be.
Richard, the last time we spoke, you mentioned Tata Motors as an investment that worked very well for you. Are there any other names in India, companies, large caps or mid caps, that are a high conviction investment idea for you?
Well, I think the auto sector is an interesting area in general. Tata Motors, ironically, of course, has benefited from its ownership in JLR and its international success. Its Indian business is really struggling. But I would highlight some of the other auto manufacturers, and that general sector is a place that when we see a pickup in domestic consumption and domestic confidence, I'd expect the auto companies to do very well.
Richard, talking about the budget again, as an FII, are there any sector-specific or investment-specific recommendations or expectations that you have from the budget?
Well, obviously, we don't know what the budget's going to hold. But clearly, we expect infrastructure spending to pick up. We expect areas like cement to benefit. And generally, as I've said, domestic cyclicality is the way you want to be positioned, in my view.
Richard, let me just get a broader perspective from you as well, on EMs as well as developed markets at this point. The key risk right now is what's happening with oil prices. How do you read the Iraq situation and what it means for oil prices going forward?
Whilst the recent upsurge in violence in Iraq is obviously unfortunate and has had some short-term impact on the oil price, we don't think it changes the fundamental dynamics of the market, mainly because Saudi Arabia remains the swing producer and does have the ability to raise production were oil prices to spike. So I think the impact of Iraq is likely to be short-term.
Right. The situation in Iraq seems a bit grim for market sentiment as well. Do you believe that the markets could see more pressure on the downside given this risk, and if so, how much?
I think that the events in Iraq have been used as a bit of an excuse by investors to take profits. I'm not sure that the direction of events in Iraq will have a significant bearing on the direction of equity markets over the next few months.
Also, how are you looking at the Ukraine situation? Because that has not settled either. So that's another risk to go by with as far as emerging markets are concerned. How do you account for that risk in your overall EM strategy?
Well, ultimately, my view is that political risk needs always to be factored into equity valuations. So we would expect investors to put a discount on Russian equities because of the heightened geopolitical risk, and that's in fact what's happened. I think from a Russian point of view, we've clearly passed the worst point of the crisis, and Russian equities have rallied sharply in the last couple of weeks, reflecting that view.
Post-elections, do you feel that India's profile as an investment destination has improved among emerging markets? I mean, you would be speaking to a lot of investors and fellow fund managers. Do you get that sense that India's position looks much better than other emerging markets?
Oh, I think amongst the large emerging market economies, India is probably the one that foreign investors are most optimistic about at the moment. Clearly, Russia has its problems. Brazil isn't really growing very much at the moment despite the World Cup. China's got its issues. So I think international investors are feeling pretty optimistic about India at the moment.
Richard, for someone who tracks money flows, do you have a sense on the kind of money that's waiting on the sidelines to get into India, especially post the budget, that being, of course, the next trigger for the market? Could you give us a sense on what kind of inflow could the Indian market see over the next 6 months, especially the second half of this year? As also, how much incrementally you would be allocating to the market if you're looking at rebalancing your EM portfolio with perhaps a slightly higher allocation to India?
Well, I think to a certain extent, the extent of flows into India is really reliant upon the extent to which global investors buy emerging market equities in general. If we see a broader pickup in sentiment towards the asset class, then I would expect India to participate in that and maybe attract a significant part of those flows. If, on the other hand, investors remain pessimistic about the broader emerging market story, whilst India will still attract some flows, they'll be significantly reduced.
Richard, also globally, are you disappointed with the growth situation? The World Bank has downgraded global growth, citing concerns coming in from Ukraine, Russia. Also, there's that big risk of when the US actually moves on hiking rates. Tapering has pretty much been factored in, but tightening is the next big issue that the market has to deal with.
Well, I think the biggest surprise for all investors in 2014 has been the direction of US interest rates. There was a very broad consensus that US interest rates were going to rise this year, and 10-year yields have fallen. I would expect that they will gently rise in the second half of the year, but we're not expecting the US bond market to be a significant source of risk for the emerging market asset class over the next few months.
Since we have you with us, Richard, I can't let you go without asking your view on China. Do you think it's a risk or an opportunity right now?
Well, China's clearly a bellwether for emerging markets in general, and investors have been disappointed by the deterioration of the Chinese economy, for the last 12 or 24 months. The most recent data that we've seen suggests a stabilization and perhaps even the beginnings of a recovery in China. So we'll see in the second half of the year. But if China does stabilize, I think that's very positive for emerging markets.
And finally, Richard, before I let you go, as you look into the second half of this year, where do you see the opportunity to make money? Where can investors generate alpha in this market?
I think the second half of 2014 is going to be defined by how the emerging world recouples with the developed world. If that takes place through growth rising in places like China and India and other emerging markets, I think that's very bullish for emerging market equities. And I think in that context, you want to own more cyclical emerging market equities. If, on the other hand, the recoupling takes place through the developed markets slowing down, then that will continue the trend that we've seen in recent years of bond markets performing very well, and I'd expect emerging market debt to do better than emerging market equities. So I think that's really the key issue for the second half of 2014.
Joining me on the show for the next leg is Tai Hui, who's Chief Market Strategist, Asia at JP Morgan Asset Management. He joins me from Hong Kong. Tai, good to have you on the show. My first question to you is about the consolidation that the Indian market has been witnessing over the last couple of weeks. Is the hope rally over and reality setting in, you think?
Well, I think certainly there's been a huge amount of optimism right after Modi and the BJP has been voted in. And clearly the momentum in the market has been extremely strong. So I'm not that surprised that we're going through a consolidation right now. But nonetheless, I'm still optimistic in the longer run, medium to longer run with the Indian markets, because we believe that the political good news may have been priced in, but I think we've still yet to see the economics react favorably to the new government. I think, as you rightly mentioned earlier, we are seeing some potential challenges on the horizon. For example, potentially poor monsoon and food inflation, and also oil prices rising is clearly a risk to India as well. But overall, I think we are looking towards a medium to longer term, still a positive outlook for the Indian market.
Right, Tai, since you mentioned inflation, what is your outlook there? Because that's keeping the RBI, the central bank, off from cutting rates. What is the expectation on the trends on inflation?
Well, frankly, I think even before this, the risk of poor monsoon starting to unfold itself, we have not been expecting the RBI to be able to cut rates anytime soon. At the end of the day, despite the optimism on the economy, the level of inflation with or without the monsoon was still, or without the poor monsoon, was still running relatively high and maybe a little bit too high for RBI's comfort to cut rates. And also bear in mind that the US Federal Reserve is still in tapering mode. They're likely to raise interest rates next year. So all in all, I think the room for rate cuts in the short term continues to be very limited. In fact, I'm sure that you've heard on the ground that the prospects of rate hike is now being discussed a little bit more compared to 2 or 3 months ago. So I think on balance, I'm still expecting interest rates to stay roughly where they are right now. But I think that the risk of a rate cut is still quite far away from where we are now.
Yeah, but Tai, how long do you think this consolidation would last? Do you think the budget would be the next trigger for the market to move higher from here?
Well, I think it's difficult to gauge exactly how long the consolidation is going to be. For example, if you look at the S&P 500 in the past few years, consolidation tends to be maybe a couple of weeks or 1 or 2 months, but the overall uptrend continues to be intact with the S&P 500. I would not be surprised to see something similar with India, given the amount of optimism and prospects that's coming through. Now, whether that could be the next trigger for the new phase of rise in the union budget, timing-wise is a possibility, but I do question of what kind of policies that's going to come through that could renew market optimism. Personally, I'm more relying on the economic data or corporate sentiment to drive the next leg up. But the union budget is a potential candidate, but it really needs to take something very special for the markets to react very favorably, given the fact that a lot of the political good news is now priced into the markets.
But what about growth expectations? Because if the economy doesn't revive as it was initially expected to, then would that mean that the market upside is also capped?
The Indian economy is huge. And not only that, but also corporates in general, not just in India, but globally, it takes a long time to implement their investment strategy. So, we may not see data really pick up until 2015 calendar year. But I think what's important also is to appreciate that some of the companies are starting to plan ahead, and whatever messages that you're going to get from the companies in terms of their future investment plans, the market may take one step ahead and price that in before they get confirmation from the economic data. So I think obviously the data themselves are going to be crucial in defining the timing. But to me right now, I'm not just watching out for the data, I'm also watching out for messages from the corporate sector and their intention to step up investment in India.
Tai, what about the big rally that we've seen in cyclicals? Do you think it's too late to chase cyclicals now, or do you believe that a core portfolio exposed to India still needs to have a big overweight on cyclicals and economy-related sectors?
Well, I think obviously we've seen a very strong performance in India year to date, and largely on the back of the cyclical sectors that you mentioned. But the reality is the economy has been in a very slow growth mode for 2 or 3 years now. So I do think that while valuation at the current level may not be awfully attractive, but I do think that earnings upgrade is very much on the cards. So that should fuel a more rally in the cyclical sectors going forward.
Stepping back a bit and talking about the global picture, what do you make of the US markets then? Because they're at record highs as well. But the markets have not done much in terms of a year-to-date return, and that's primarily because growth has not picked up as was expected at the start of the year. So what's the outlook there?
Well, I think you may remember we discussed before that our expectation on U.S. equity return this year is going to be a shade of what we saw in last 2013, which grew almost 30%. But if you look at earnings growth, which is around 6 to 7%, and also dividend yield, which is around 2 to 3%, I think a low double-digit or high single-digit return in the U.S. this year is not particularly aggressive. We've seen a 5 to 6% rise in S&P 500 this year. I think you may see something similar in the second half of 2014, provided that the economy continues to grow at 2 to 3%, which we believe it will.
But what does the outlook for the US mean for the developed market versus emerging market trade? Do you think that on balance, developed markets still offer a favorable risk reward?
Well, I do think that developed markets still has an attraction. For example, we do believe in a strong dollar. We also believe in the fact that the US economy is gradually getting out of this crisis mode. Europe is still a long way from normality, but nonetheless, direction is encouraging. But I think if you look at the capital flows in the past at least couple of weeks, we're starting to see a resumption of interest back into emerging markets, partly because valuation is now of emerging markets a very, very favorable discount relative to developed markets. And meanwhile, some of the economic momentum that benefited developed markets are starting to spill over into emerging markets. So I think one of the holdback or pushback on EM has always been a lack of earnings or earnings growth, and frankly that is still the case, but valuation, currency concerns are starting to turn more positive. So I would encourage investors to look a little bit more closely at emerging markets, not just developed markets.
Final question to you, Tai, and that's, do you think that the Indian market is a bit of a crowded trade right now? And that's fine, that's justified, given that India's investment profile has improved among emerging markets.
Well, I think it deserves to be a crowded trade if you look at the future of growth. If you look at China, growth will be where they are right now, probably slightly downside. Russia, Brazil, similar picture. India is, to me, a clear candidate where growth over the next 12 to 18 months is going to be faster than where we are now. So I think that's worthy of a crowded trade. But at the same time, if you look at the valuation, India's always been a little bit more expensive compared to its peers in Asia or elsewhere in emerging markets. So I'm not that concerned. I'm really comparing India with its own history, which is just above its fair value.
Fair enough, Tai. Thanks very much for joining us and giving us your perspective on the Indian market. Really appreciate your time.
Thank you.
With that, we come to the end of this edition of the FII View. Thanks very much for watching the show.